Good evening and welcome. If you are a senior living in Canada and receiving benefits such as the Canada Pension Plan or Old Age Security, this update is especially important for you. Federal authorities have officially confirmed new reminders and processing updates through the Canada Revenue Agency that could directly affect how much money you receive back this tax season. Many retirees focus only on filing their income tax return and reporting their pension income. But what often goes unnoticed are specific tax slips and benefit-related forms that could significantly increase your refund. Tonight, we are taking a closer look at three key tax forms that many seniors overlook. Forms that could mean the difference between a small refund and a much larger one. As we begin, it is important to understand why this matters right now. The Canada Revenue Agency has been modernizing its processing systems and encouraging Canadians to carefully review all issued slips before submitting returns. At the same time, adjustments to the Canada Pension Plan and Old Age Security payments, including indexing increases, have changed the amounts many seniors are receiving. When payment amounts change, the tax treatment of those payments can also shift. That is why accurate reporting and understanding which forms apply to you is more important than ever. Let us begin with the foundation. If you are receiving Canada Pension Plan benefits, those payments are considered taxable income. The same applies to Old Age Security benefits. Every year, the government issues official tax slips reflecting exactly how much you received. These slips are not optional paperwork. They are essential documents that must be included when you file your income tax return. However, beyond simply reporting income, some of these forms also open the door to credits, deductions, and benefit adjustments that could increase your refund. The first form we need to discuss is the T4AP. This is the tax slip issued to anyone who receives Canada Pension Plan benefits. The T4AP shows the total CPP payments you received during the year and any tax that may have already been deducted at source. Many seniors assume this form only matters for income reporting, but here's what often gets missed. The amount of tax deducted at source could be lower than what is ultimately required, or in some cases higher. If too much tax was deducted from your monthly CPP payments, you may be entitled to a refund. If you never requested voluntary tax deductions and your total income remains modest, your actual tax obligation could be lower than expected once credits are applied. That difference could result in money coming back to you. Now, consider this carefully. Many retirees do not adjust their CPP tax withholding when their income situation changes. For example, if you stopped working mid-year, or if your investment income decreased, the tax deducted from your CPP might no longer reflect your real tax situation. When you file your return properly and apply all eligible credits, you may discover that more tax was withheld than necessary. That's not a mistake, that's an opportunity for a refund. The second critical form is the T4A-OAS. This slip reports the total Old Age Security payments you received during the year. Like CPP, OAS is taxable income. However, OAS has an additional element that seniors must be aware of, the OAS recovery tax, often referred to as the OAS clawback. If your income exceeds a certain threshold, part of your OAS benefit may be reduced. Federal authorities have officially confirmed the income thresholds for each taxation year, and those thresholds are indexed annually. Here's where many seniors miss a potential refund opportunity. Even if some OAS was withheld due to estimated income levels, your final taxable income after deductions and credits may fall below the clawback threshold. If that happens, you may recover some of the OAS amounts that were withheld. Proper reporting of deductions such as pension income splitting, medical expenses, and age-related credits can reduce your net income and directly impact OAS calculations. This is not automatic unless the return is filed accurately and completely. Now let us move to the third form that could significantly increase your refund. This is the T4A slip related to other pension or retirement income, including registered retirement income fund withdrawals or other annuity payments. Many seniors receive multiple income sources, and each one generates a separate tax slip. When these slips are entered correctly, they open access to the pension income tax credit. The pension income amount allows eligible individuals to claim a federal credit on up to a specified portion of qualifying pension income. In many cases, this credit alone can reduce your tax payable and increase your refund. What makes this especially important for seniors is that some do not realize that certain types of pension income qualify while others do not. CPP and OAS alone do not qualify for the pension income amount credit. However, income from a registered retirement income fund after age 65 does qualify. That distinction can be critical. If you or your spouse have qualifying pension income and it is not reported properly, you could be leaving money behind. Another area that directly interacts with these forms is pension income splitting. Canadian tax rules allow eligible couples to split up to 50% of qualifying pension income with a spouse or common law partner. This strategy can reduce overall household taxes and may increase refunds. It can also reduce exposure to the OAS recovery tax. When income is shifted between spouses to balance tax brackets, the total family tax bill can decrease. That's not a loophole, it's a permitted strategy confirmed under current federal tax rules. Beyond these three core forms, seniors should also pay attention to other slips that interact with CPP and OAS reporting. For example, if you paid into a private pension plan or received disability benefits through CPP, those amounts will appear on separate documentation. If you made contributions to certain plans earlier in the year, such as RRSP contributions before age 71, those deductions can lower taxable income. Lower taxable income can mean a lower tax bracket, reduced OAS clawback exposure, and potentially a larger refund. Another area often overlooked is the age amount tax credit. Seniors aged 65 and older may qualify for an additional non-refundable tax credit if their income is below a certain level. The value of this credit gradually reduces as income increases. When combined with the basic personal amount and the pension income amount, this credit can significantly reduce federal tax payable. If tax was deducted from CPP or other pension payments during the year, these credits may convert what would have been tax owing into a refund instead. Medical expense claims also deserve attention. Seniors typically have higher medical costs, and many of these expenses are eligible for a non-refundable tax credit. Prescription medications, certain medical devices, travel for medical care, and health insurance premiums may qualify. When added together, these expenses can reduce taxable income and potentially increase refunds. It is important to keep receipts and ensure all eligible costs are reported accurately. Now let us discuss how these updates connect with recent administrative changes confirmed by the Canada Revenue Agency. Processing times have improved for electronically filed returns, and direct deposit remains the fastest way to receive refunds. Federal authorities have encouraged seniors to use secure online access to review issued slips before filing. This reduces errors caused by missing forms. Many refunds are delayed not because of complex issues, but because a single slip was omitted or entered incorrectly. There is also increased communication about the importance of verifying tax deductions at source. Seniors who feel too much tax is being deducted from CPP or other pensions can request adjustments. However, even if no changes were made during the year, the annual tax filing process is where reconciliation occurs. That is when overpayments are returned. Let us be clear about something important. None of these refund opportunities are automatic unless you file a complete and accurate return. Even seniors with low income should file annually. Certain credits and benefits, including the GST credit and provincial supplements, depend on having a filed return. Filing is not just about paying taxes, it's about protecting your entitlement to benefits. As we move forward in this report, we will break down each of these three critical tax forms in greater detail. We will explain exactly where to find them, how they affect your refund calculation, and what practical steps you can take to ensure nothing is missed. We will also review real-world examples showing how proper use of these forms can result in hundreds or even thousands of dollars returned to seniors. If you are receiving CPP, OAS, or other retirement income, this information applies directly to you. Small reporting errors can cost money. Careful attention can put money back in your pocket. In the next segment, we will examine the T4AP in depth and show how it interacts with federal and provincial tax credits to potentially increase your refund. As we close tonight's report, the message is clear and it is important. Filing your tax return is not just a yearly obligation. For Canadian seniors, it is a financial opportunity. The difference between a modest refund and a significantly larger one often comes down to understanding and properly reporting three essential forms: your T4AP for Canada Pension Plan benefits, your T4A OAS for old age security, and your additional pension income slips that may qualify you for valuable credits. These documents are more than paperwork. They are the key to unlocking credits, recovering withheld tax, reducing potential clawbacks, and ensuring every dollar you're entitled to is properly calculated. Federal authorities have officially confirmed that tax credits, pension income splitting rules, and income-tested thresholds remain in place to support retirees. But none of these advantages apply automatically unless your return is complete, accurate, and carefully reviewed. Many seniors unknowingly leave money behind simply because a qualifying pension income credit was not claimed, a medical expense was not included, or income was not optimized between spouses. In today's financial environment, where every dollar matters, overlooking even one of these forms could mean missing out on a larger refund that rightfully belongs to you. The most important takeaway is this: review every slip issued to you. Confirm all income is entered correctly. Apply every credit you qualify for, and file on time. Whether you receive CPP, OAS, private pension income, or withdrawals from retirement savings, careful reporting can lower your taxable income and potentially increase your refund. A few extra minutes of attention today could translate into meaningful financial support tomorrow. Stay informed, stay organized, and make sure you don't miss what could increase your return this tax season.